time? Anything now? Testing, testing. Okay, testing. Good afternoon. It is Friday. Hello. Anybody there? Anybody able to hear me? Anything going on here? Nothing? Yeah, I'm speaking. Yes. Are we live? Got me. Yes. Okay. Well, hey, that's technology for you guys. Anyways, looks like we're live. I'm gonna have to keep an eye on that other machine. In fact, I'm hearing yes, we are live. So let me just type that into Twitter. Now live. Hold on 1 minute. Sorry for the lack of professionalism, but that's not what I get paid for. I get paid to look at the market. So let's take a look at these markets. I don't get paid for this. But let's take a look anyway. The S&P 500 obviously had a rough day today. There were 2,800 declining stocks, 291 advancers. That number just got worse throughout the day as it was a steady sell-off. We saw the market gap lower down below daily S2, and then it tried to recover briefly with a short period of higher highs and higher lows. And it was briefly above the daily volume weighted average price. It got back below that VWAP and then began the steady sell-off throughout the day. So we have this market now down, obviously at the low end for the week as well. We are, we closed with losses this week. The prior, our closing low was actually on Tuesday. We had a rough session, obviously Tuesday. Two fairly decent sessions, actually, especially Wednesday, but this market fell short of that 200-day moving average. And all week, what we were seeing was we had light volume, and today we had a little bit of we had a news headline with a jobless number, and there's just a lot of reasons not to want to buy stocks right now. It's the beginning of summer. We've got all these sovereign debt issues. We've got the oil. We've got this. The jobless numbers, and not much confidence in anything economically, politically. It just doesn't seem like a good environment to be owning equities in, and that's what the market's telling us as well. We had been, you look at this thing, this market is pretty complacent the last week and a half as it was gyrating back and forth, and I think it's, this volatility is maybe wearing out a lot of participants in here that they look at it and they think they've got it right one day as it gaps up and makes a nice run, then a sell-off with a gap lower, then a huge rally, and now a big decline. So that begins to really wear on the nerves of a lot of participants. As I've been saying consistently since we broke that 118.50 level, that we are in an environment that is acknowledging risk more, and that most people should still be on the sidelines unless you're a very aggressive short-term trader, which most people, I don't think that really defines most people here. I think that the people who are listening today, I think a lot of people are good and active traders, but I think a lot of other people just tune in to kind of look at the madness, is what it seems. And I base that on some feedback that I get in emails and that sort of thing. But obviously, if you're here on a Friday afternoon, you're interested, and we've got this market that has some, should be finding support in this area down towards about 102. I was talking about the scenario, and this was before before the audio went out. But I was, earlier, a couple of weeks ago, comparing it to 2007 and saying perhaps we're in this environment where we turn sideways and then move higher. The longer it takes to do that, the less likely it seems as though that's going to be the scenario for this market. It just cannot string together more than 2 days or a day and a half of buying. In fact, we had 2 days of buying with Wednesday and Thursday this week, but beyond that, it's just a really difficult environment. We've got a declining 10, 20, and 50-day moving average, and we're stuck below that 200-day moving average, which is starting to become reason for concern. As I had said a couple weeks ago, that it's typical, or it's not typical for the market to reverse all at once just because you see it breaking below the 200-day moving average. We've seen numerous examples in the past. It's not typical. Nothing in the market is a rule, though. They're all probabilities, and the probabilities don't favor, I think, a bigger breakdown through that 102 level. But 102 is still a pretty scary distance from where we are. It's another 5% lower, so 4.5%, and it looks reasonable that we could continue down towards that 102 area. And if you just take a look at the Fibonacci off of the March lows to the recent high, we haven't even retraced a third of those gains off the lows. So far it's still just it's a pullback really, but it's giving us reason for more concern, the more time that it takes to recover from this. But perhaps this market's heading down towards 101, 102, and as long as we continue to have this choppy type of environment, it really favors shorter term trading and trades that you have to be willing to move out of the way very quickly, and yet you want to be willing to play both sides of the market as well. There's just there's longs that are working for periods of time, there's shorts that are working for periods of time, and there are still some intact uptrends in the overall market, but they're just rarer and rarer to find. So again, we've got a broken market. We're down 3.5% today in the SPY, down 3.43% in the Qs, and the Qs had been holding up much better than the S&P 500. We see that 5-day moving average had been an area of support. Well, it bounced this morning and looked like a nice recovery as it was holding above that volume weighted average price. Then it dropped below it, and we had lower highs and lower lows, and same thing, just a continued sell-off here. So there's just a lot of danger in this market overall. We had briefly gotten above this little trend line here, which is where that 20-day moving average was as well. And that's what I've been talking about on the SPY, is that perhaps we're going to get up to the 20-day moving average in this trend line, which is also the approximate location of the average price since the market broke down. So there's the volume weighted average price, and that's going to be coming down. That's a moving number. It's now down at about 111.76. But we've got, really, look at this 65-minute time frame. We've got a real choppy mess, and that's really the type of environment that's going to frustrate a lot of people. So the way you deal with that is, again, to keep your time frames shorter and to trade smaller share size. This is not, in my mind, the environment to be swinging for the fences. Now, there's always a low risk setup that maybe you can get involved in, either long or short, where if you can see the opportunity to manage risk, then that's what it always comes down to. But you've just got to be more vigilant about that risk management. So the Nasdaq, again, it's broken its lows for the week here as well. We're still above that 200-day moving average on the Qs, but it's selling off on lighter volume. So realistically, you can look at this as, here we had this drive lower and this drive lower. What was the trend of volume during those drives lower? The trend for volume was higher. When we had this little recovery and we had this recovery, what was the trend for volume? Generally, it was weaker. So that's not what we want to see. As I always say, only price pays, and I'll say that to my grave, because we can look at it and we can still rally 5% or more on light volume, but it just means be extra vigilant. Now, if you're looking for a turnaround, then you want to see big volume stabilization and then big volume on the up days, followed by lighter volume pullbacks. But look, this rally back in here, just back in March and April, a lot of people were complaining, well, it's on light volume, and the volume was diminishing that whole way up. But if you were looking at volume only, you missed a hell of a rally from about 45 to 50, to 50. So, volume is a good confirmation, but it doesn't always have to confirm. It can diverge, and the market can continue to rally without big volume, as we'd seen, like I said, mid-February to mid-April. So for the NASDAQ, it looks like we're probably at some point going to test these levels down here. Now it's trying desperately to hold that 200-day moving average. So markets correct one of two ways. They either correct time-wise, which we've seen, or I'm sorry, price-wise, which we've seen, or they're going to correct more through time. And it seems as though this choppy environment, again, what I'd said a month or so ago up in this area was volatility tends to peak at turning points and diminishes with the trends. Well, perhaps this is a turning point because we've seen some massive volatility. I'm not going to stick my neck out on the line here because there's absolutely nothing to gain from saying here's where I think the market's going to be in a month. Higher or lower is really irrelevant. The point is, how do you manage risk in between, and can you find some good ideas to trade? It's not about where the market's going to be, December 31st of this year. Is it going to be higher or lower? That's that's good for sound bites and that sort of thing, but it's not going to help us make money, and that's the job, that we're trying to make money each and every day. So the Russell 2000 got hit harder today, and that's kind of been getting hit a little. The selling's been, the Russell has been the strongest market group this year, and then we've seen recently that it's continued to hold up amongst the best as it holds this 200-day moving average. But what we saw today was a 5% sell-off in here. So I think that it's broadening out a little bit. And again, if we go back to the breadth, you can really get to understand, I think, the choppiness of this market. If you take a look at the advanced decline line, it's just been extremely, and this is just the advancers and decliners, advancers in green, declining stocks in red. It's been extremely one-sided. It's either all up or all down, pretty much, except for maybe this day here was a little bit flatter. But today, I mean, and lately, most of them, it's actually been about split. If you look at it, all these days with 2,500, 3,000 advancers, and then you have these big days of decliners. So it's just confirming that choppiness of this market and the type of environment that generally is going to frustrate a lot of people. So this market has also been holding pretty much right around the January highs. Seems as though it's starting to have more trouble. Again, we've got bigger volume coming in on the downside, and we've got this market starting to lose some of the relative strength that it has enjoyed all year. Because again, today the SPY was down 3.89%, or I'm sorry, 3.51%. Nasdaq down 3.43%, and the Russell was down 5%. So the semiconductors were kind of acting like a more stable group. But when we have that declining 50-day moving average, you can't trust rallies for more than maybe a swing trade at best. But then if you have a decent shorter term time frame to look at, which we really don't. The semiconductors yesterday looked as good as they have in a while, above this rising 5-day moving average, higher highs and higher lows, and this is why you never want to buy on those after those bursts. You wait for the pullback and then the reemergence of strength. So today, if you were looking at semiconductors, you don't buy it at the end of the day looking for the breakout. If you miss it, you miss it. But instead, you wait for a pullback and then look to buy strength and set your stop underneath that higher low. So there's no reason to be getting involved in these down days like this. Now, today, what happened? This market gapped lower, ran up, and then when it broke that volume weighted average price, and the volume average weighted price was declining, same thing as all these other other markets. So Financials were down 4% today, so they weren't horrible in terms, relative to, for instance, the IWM, but we do still have a clear pattern of lower highs and lower lows in the financials, and they look like they're going to test the 14 level and maybe even down towards that 1360. On the weekly time frame, they're really just looking. This is going to be a big level down in here, this 13.5 area, and we're getting so close to it that I think that even the shorts in the financials should probably be left to day trades, and they kind of have to be when you look at some of these rallies as well. That I know I can't stick through a short when they rally like this, especially if you're trading the leverage products, because the leverage products, obviously, the percentage moves and that sort of thing are just going to be so much more difficult to hold through. The IYR has been pretty strong recently as well, relative to the rest of the market. We had seen that it had gotten up to this prior support, and again, it's not an exact level, but with that declining 50-day moving average, we saw it break down, rally up just a little bit on some volume, and today it really got smashed a little bit harder, down 5.5%. So what's been some of the stronger groups is now succumbing to a little bit heavier profit taking, because the IYR, the IWM, those have both been a little bit stronger. Now, gold was up $1.23. It's still in an uptrend. It's the bigger important level of support is going to be down near that 115 level. It's starting to, it was looking like it's starting to get a little bit heavy in here, and I think that had you been a swing trader, you should have been out as it got below that 5-day moving average. It's recovered today, obviously. So the next bigger move from gold, I think, would come above about 123.30 or so. The disturbing thing for a lot of participants is that the GDX continues to, you just can't make money in the miners. We spoke last week about SA, and SA. Had a real tough week. Monday was a horrible day for it. We were looking at Newmont mining. It just can't get back above this level where it previously broke out. And these are some of the bigger ones, like Nico Eagle. It's broken. You look at Coeur d'Alene. These are broken stocks, and that gives reason for concern. Why aren't these gold stocks going up when we have gold higher? Are they hedgers or whatever it is? I don't know. Today Trader, my buddy, pointed out to me today that silver's really starting to diverge as well, and silver experienced a breakout to new highs, or at least for at least the last couple of years. These are where 2008 it was higher, but it broke out and failed, and now you're looking at this thing. It's going to have to get back up above 1850, I think, before you can take the long side seriously in shares of SLV. So let me just, I'm going to talk real quick just about one stock that I had mentioned today on Twitter, ABTL, and this is why it's a trader's market. I said I was buying it right here at 128, and then I sold some at 135 and at 138, and I said the balance on my stop was at 129. Well, the balance on the stop was 129 because that was a penny above what I bought it for, and I figured if I get stopped out there, I don't really lose money after commissions, and I had already taken half of my position off, and that was the right thing to do. You just can't trust these stocks, and you might look at this and say, well, why are you wasting your time with a little dollar stock? Because I can make 5% in a couple of minutes, manage risk, and it's got plenty of volume. Now, that's not the only thing I traded, but that's the only thing I tweeted, so that's the only thing I'm going to talk about with you guys here today. But let's take a look at some of the ideas that you guys have, and some feedback on those. Going Mackay wants me to take a look at Clean Energy Systems, CLNE, and let's take a look here. Clean Energy Systems on a 10-minute time frame has a nice pattern of higher highs and higher lows. I would say if you're in it, a stop probably right about maybe 1630 or so. You give it a little bit of room. On the daily time frame, it's bouncing within a downtrend. I wouldn't be surprised that it runs into some resistance up near about 18 bucks a share if it can continue higher. It's got that declining 50-day moving average. The 20-day moving average is declining. Now, it's a bounce within a downtrend is the way I view it. could get up towards that 50-day moving average. If you've been in it, then it looks good. Stop underneath this recent higher low. Let me just scroll back because I bet you that some people had, and just one stock, please. If you type in more than one, I'm simply just going to take the first one that you put in and ignore the other ones. Someone had asked me earlier today, about a half hour ago, and I forget who it was. They were saying something about Pfizer. How about taking a look at, in this environment, buying a stock with a good paying dividend and near their 52-week low? Well, let's say Pfizer pays 5%, and it's going to take you 5% to earn that. Meanwhile, over the next year, I wouldn't be surprised to see Pfizer trading down at $12 a share. $12 a share, so that's another 25% lower. Is it worth it to collect 5% in dividend and lose 25% of your original capital? Of course not. Pfizer's a broken stock. It's in a downtrend. The trend is lower. There's no way that I would be looking at this. Don't make the mistake of buying stocks for their dividend if they're in a downtrend, because number one, there's probably a fundamental reason that they're down as well, especially with a stock like Pfizer, who's been in a downtrend since the beginning of the year. There's probably something fundamental that this stock has been underperforming the market since the beginning of the year, and it's been underperforming the market over the last 10 years or so as well. Since it's been a horrible stock to own, going back to 1997. So a dividend is not a good reason to buy a stock. I heard something about BP today, and that all these 80-year-old grandmothers are concerned that they're going to lose their income because they're concerned that the dividend that they're getting from British Petroleum might be in jeopardy. Well, wake up, Grandma. It's British Petroleum could very well go out of business from this whole thing, and I think a lot of people hope they go out of business. But you can't buy for a dividend. There's a lot of people crushed in here, and I would say British Petroleum. If you're in it for a dividend, then you just can't really hold them. Ike, I would love your take on the Euro-US dollar going forward. Jim, I don't look at I can only look at the FXE or the UUP, and FXE is just, it's in a downtrend. There's just it's in a clear downtrend. There doesn't seem to be any reason for anyone to buy this thing. The UUP is the dollar, so I guess you can make your own pair out of it that way. But I don't have the Forex pairs because I don't trade them. But the UUP is breaking out to new highs, so higher highs and higher lows. Beautiful uptrend for the U.S. dollar, one of the strongest trends there is right now. And FXE is probably one of the strongest downtrends. I remember a couple of weeks ago people were asking me about buying it in here, and it just doesn't make sense to buy these things. Even when they get above that 50-day moving average, people get excited. Hey, it's back above the 50-day moving average. What's the direction of the 50-day moving average? And Jim, I think you're bearish on this for fundamental reasons, and that's it seems to be the right thing based on what everyone says. But technically, it's just a disaster. It's going to have to get it back above 121 before it has any chance of recovering a little bit. It's similar to the favorite stock for people to lose money in over the last 3 years, which is UNG. UNG is still in this longer-term downtrend, and you look at the daily time frame. Yeah, it's perking up, and it broke that level that we were talking about a couple weeks ago. And UNG could potentially head up towards maybe 875, maybe 9.25. But these trends take a lot of time to turn around. So maybe UNG tests its 50 or 200-day moving average up near 930, and that would be a good, be a nice trade. Obviously, I know that wasn't the question here, but I was just wanting to compare it because FXE. There's people that are looking at it and saying it's down too much, and it's just not down too much as long as there's still sellers out there. Let's see. More Chocolate is asking, I'm just going to take a look at your first one, which is Akamai. Akamai, are these stocks on sale here in the intermediate term time frame? I don't see this stock as being on sale at all. It's been in a very nice steady uptrend. It broke some resistance at 40.5 this week and made a nice continuation higher. Today it's pulled back a little bit. It gapped down, tried to recover, and then pulled all the way back. So I would think that the better support should be found at about 40.5. If it breaks back below 40.5, then I would be concerned that maybe Akamai cannot continue higher. But it's in this beautiful uptrend, and it's funny that you mentioned those three stocks, because I was looking at those and a couple other ones, and their charts look very, very similar. You take a look at APKT on the daily time frame, VMW, THOR. You look at CRM, CMG. These are all stocks that look, and even Netflix, they look kind of the same, where they had this this gap higher and a continued run. They got choppy in here, but they're continuing back to the upside, and that seems to be a pattern for a lot of these stocks that have been leaders lately. So Cyber2 Trader wants to take a look at Regency. I think this is one of those. Oh, no, it's not. Okay, I thought it was one of the banks, but limited partnership. Be careful. I got some important tax documents in the mail yesterday from Blackstone Group, or was it Fortress, and one of these LPs. They are just horrible with their tax stuff. I don't even know what they are, and I told my accountant I just want to throw them away. He said send them to him, but Regency Energy Partners. Anything with energy, I would be just a little bit suspicious of, just because it's gonna. You would think it's gonna get knocked down just based on perception of that group. But it's been in this really nice steady uptrend since late, since November of 08. Just a real nice steady uptrend, and here's where it looks like it has the potential to run up to before it encounters resistance. So maybe it has room still up towards 25 bucks a share. I would be more interested in buying this stock for a dividend, because I'm sure that them being an LP, they probably pay a big dividend, but I would say with a stop under near probably 22 bucks a share. But realistically on this daily time frame, it looks kind of neutral, like it's digesting some gains. If it can get above these recent highs, maybe it can continue higher. So now I'm just looking at these comments that have lost audio. Okay, so Hunt Richardson wants to take a look at DirecTV, DTV. DirecTV is in it's in a nice uptrend. Look at this weekly chart. This is one of the few really nice, neat uptrends on a weekly time frame. Starting to get a little bit volatile in here with these bigger tails, and those bigger tails mean that it traded a lot higher during the week, but then closed much lower. If you look back, where's a similar type of they call them topping tails. You'd say right here it might look similar. That's somewhat indicative of distribution. It doesn't mean that it's falling apart. It's still clearly in an uptrend. Looking at a daily time frame, though, see what it means is it traded up to here this week, but came back down. So here's the 4 days that construct that candle. Here's the low end of that candle. Here's the high end, and so our candle would look like. Well, it would look like this. Let's just look at the weekly chart, and they call that a spinning top or something like that. But don't pay too much attention to candle formations and that sort of thing. What you want to pay more attention to is what's the message of the market on different time frames. So if we look at, for instance, maybe a 65 or a 10-minute. Where's my chart? More technical trouble. How annoying is this? So all I have is a daily chart, it appears, and I don't know what the reason for that is. Let's come back to DirecTV and take a look at another one. How about COP? So again, if you type in more than one symbol, I'm not gonna answer more than one symbol. Are you fucking kidding me? Is my internet down? Alright, well, here we go. Let's take a look at DTV. I think my internet went down. I don't know what the heck happened there, and I don't think I'm back up either. So, what a pain in the ass. Okay, we'll connect. Send me a text now. What's going on? All right, testing. Oh, come on, man. Oh, you can hear me? Maybe no stock charts. Can you guys hear me? See, it doesn't look like my internet's working either. Oh, I'm back. Boy, I don't know what the issue is here, but okay, where were we? We were on DirecTV. Let me see if I can type that back in and see if this thing will work. What's up with Realtek? Why is Realtek suddenly not working for me? Well, that doesn't help us much. You can hear me curse, but you can't see my charts. So, I don't know what to tell you. I guess we're going to have to cut this early. I apologize for all the technical issues. I appreciate your trust in my analysis and in sticking around here this afternoon, but we're going to have to call it quits here because my charts don't want to work all of a sudden. So anyways, I'm going to cut it off here. Thank you everybody for your time. I hope you have a great weekend, and I will talk to you next Wednesday.